Hello everyone. Thanks again for stopping by for another WealthBuilder 101. We're going to cover our second portion of Forex pairs. I'm Jade and I have with me Brian.
Hello everyone.
So, some of the major Forex pairs are anything delineated with the US dollar in it. For example, euro versus dollar is the euro dollar. It is the most liquid pair of all the foreign currencies. Now what you want to do is you want to really focus on the ones delineated with the US dollar because that means you have the most liquidity. When you have the most liquidity, you get better fills and you have less chances of slippage and a tighter bid-ask spread. All that means, in a nutshell, is you'll save money. So another popular pair is the US dollar versus the dollar yen, which is just called the yen, the dollar yen. The British pound versus the US dollar, which is called the pound, the cable, the sterling. Then there is a US dollar versus the Swiss franc, which is called the Swiss. The US dollar versus the Canadian dollar, or the loonie or Canuck. And then there's the Australian dollar versus the US dollar, or sometimes called the Aussie. Now some of the more exotic pairs, they're still pretty liquid, but not as liquid as the US dollar, but they're still very tradable and very profitable for us to trade. The pound yen, the euro pound, the euro yen, the Aussie yen, and the euro CAD, etc.
So margin in Forex is a good faith deposit made to a broker. When you open your Forex account, the broker will tell you how much margin is available to you. 50-to-1 margin, for example, means that for every dollar in our Forex account, the broker will loan us $50. Big margin equals big risk. This graph assumes that you have a 25 pip per loss in the euro US dollar trade with 100,000 starting capital and a full $100,000 lot contracts. So on the left you see our consecutive losses going 1 through 8. On the top it shows different leverages of 1-to-1, 50-to-1, or even all the way to 100-to-1 to give you an example. And on the bottom it shows, or on the right, it shows the remaining capital. And you can see how, although big margin can create big profits, your capital can get eaten away much faster when using leverage of margin at 50-to-1.
Now, U.S. brokers will only allow for a margin of 50-to-1. Now, if you notice though, if you have just a 1-to-1 margin, your risk or your potential loss is going to be much less. So the moral of this story right here is if you're really just beginning and you're not really sure how to enter a technique properly, how to put your stop loss on properly, calculate your risk management and put it in and manage your trade, don't move to leverage just yet. Get comfortable with doing just stocks, which is that 1-to-1 leverage, and then slowly move into Forex when you're more savvy and comfortable and this is all second nature to you, just because one small tiny risk can really chip away at your account.
That's right. Execute flawlessly.
Yes, execute flawlessly.
So leverage is the use of a small amount of equity money to control a large amount of brokerage money to open a position.
So what we're going to do is we're going to take you through an example of a trade from soup to nuts. We're looking at the euro dollar right now. What we want to do is we want to find a trade, and I'm going to pick trend analysis for the sake of this example. So the first thing we do with a trend analysis trade is we make sure that we're in a bull market. Now how do we define a bull market?
Higher highs and higher lows.
Great job. So as you can see, we're making higher 3-bar highs, we're making higher 3-bar lows. So now that we're making higher highs, higher lows, we've ascertained that we are in a bull market. So once we know that we're in a bull market, we're going to put our entry and our exit. And our entry is going to be at the top of the most recent swing high, and our exit is going to be at the bottom of the most recent 3-bar or swing low. So let me digress just for a second. Now, being that this is currencies are denominated in pips. So 1 pip is 0.0001 or
4 decimal points.
4 decimal points. With stocks, we have a 10-cent buffer. With Forex, we have a 3 pip buffer. So if our most recent swing high, the high of the day is 1.3447, if we add a 3 pip buffer, we get 1.3450. Now our stop loss is our most recent 3-bar low. If our most recent 3-bar low is at 1.3203, remember we have to subtract our buffer. So if we subtract 3 pips from the low, it's going to be 1.3200. Now, these numbers are important because not only is this what we're going to enter into our trading platform, but we're going to use it to calculate our risk management. So, what is the difference between 1.345 and 1.32?
0.0250.
0.0250, good. So remember that number. We're going to get back to that.
Or 250 pips.
Or 250 pips, exactly. So what we're going to do is we're going to bring you to a website called www.babypips.com. Once you're here, you're going to press the Tools tab. Press the Tools tab. It's going to bring you to this screen. You're going to come to the left side and click Forex Calculator. It's going to give you a drop down, and you're going to click Position Size Calculator. Once we're here, we're going to enter our information. Our currency that we're using is the US dollar. Our account balance is $10,000. Our risk percentage is 1%. And our stop loss in pips, this is the difference between your entry minus your exit. So do you remember what that was?
0.0250, which is 250 pips.
So 250 pips, and the currency, you can just drop this arrow. So if you're not using the euro dollar, you can just pick any one of these. We click the euro dollar, we click calculate, and we get 4,000 units. So remember this 4,000 units. So now that we have our position quantity, we're going to go to our tools, our trading platform. Now what you're going to do is you're going to look for the bid-ask. So this is the bid-ask spread I was referring to earlier, where it shows the liquidity. So the more liquid something is, the smaller the bid-ask spread is. We're going to find our currency that we want to do, which is the euro dollar. We're going to click ask. Clicking ask will create a buy order. Clicking bid will create a sell order, but we want to buy, so we're going to click buy. It will allow you to enter your information. So remember the quantity? 4,000. Yes. We're going to put a good till cancel order, and then what we want to do is we want to create a stop order, and then we're going to put 1.3450, and then we're going to attach a stop loss at 1.320, and then we're going to click transmit, and then we are off to the races. We've just entered a Forex order. Pretty cool, huh?
Very.
So, if you would like more information, Courtney has his own book called How to Make a Living Trading Foreign Exchange. It is a great book. It has a lot of his patented techniques in it, lined out all there for you. They can help you trade Forex successfully. All right, well, thanks everybody. Thanks for stopping by, and we will look forward to having you on next week's webinar. Bye-bye, everyone.